Hello, and welcome to Summit Investment Advisors Macro and Coronavirus Update. I'm happy you have successfully navigated the Zoom technology and have now joined the billions of people across the globe who are now using online conferencing. My name is Sean McDermott, and I'm the Certified Financial Planner and President of Summit Investment Advisors. Today, I'm primarily going to discuss the stock market and navigating current market volatility. I thought I'd start off with some creative imagery. This one here is from The Economist magazine, and it shows the country of China being covered by a respirator mask as they try to protect the rest of the world from the coronavirus spread. Here's the cover of Fortune magazine. It shows the virus has spread throughout the globe, and now our planet is trying to protect the rest of the planets in the galaxy from the coronavirus. So there you go. Now, on a more serious note, worldwide, there's 486,000 confirmed cases of coronavirus with 22,000 deaths. As of March 26th, 2020, the United States had 69,219 confirmed coronavirus cases and 1,054 deaths. This picture on the right here is a picture from a New York hospital where my son, Dr. Logan McDermott, works. And in New York City, they have 22% of the coronavirus cases here in the country. He said that it's a very taxing job on a day-to-day basis, taking care of these patients as you try to protect yourself. And he said that each time you visit with a patient, you actually have to double gown, double respirator mask, and put on double of everything. After you visit with the patient, then you have to leave all those layers of clothes in the room to either be decontaminated or destroyed or thrown away. So there's a severe shortage of medical supplies in the hospitals, especially in New York City, Brooklyn, New Jersey area. So my heart goes out to all those healthcare workers that are on the front line. Some important disclosure information. Headline stories, you've probably been noticing. This one's from Investor Business Daily. Dow Jones crashes 2,700 points on growing U.S. coronavirus cases as stock market correction continues. Next day, Dow claws back 1,049 points as the Fed Treasury moved to restore investor confidence. And then the day after that, stocks plunged 10% in Dow's worst day since 1987. You guys probably remember that. That was Black Monday. And then, of course, from CBNC, a couple days later, what to watch today? Stock futures swing wildly after the Dow's best day in 87 years. So this news was actually Tuesday, March 24th. Wednesday, March 25th, the stock market went up again over 1,000 points. And today, as I do this recording, which is Thursday, March 26th, the Dow Jones is having record level gains once again. So it's good to see some rebound in the market at this point. We have this index called the Fear Greed Index, and it measures the emotions of the market. 1 year ago, there was a lot of greed in the market. Even 1 month ago, investors were in a greedy stage buying up stocks. Today, it's at the extreme fear level when it comes to buying equities and stocks. People are very afraid of what's going on and what will happen with the markets. Warren Buffett, who's a billionaire from Omaha, Nebraska, and one of the richest, most successful investors in the world, he once said, "Be greedy when others are fearful." In 2009, I remember he was being interviewed by Becky Quick on Squawk Box, which is part of the MSNBC news programming. And she asked Warren, she said, "How much money have you lost in this down market?" And if you guys recall, back in 2009, stocks were actually down about 40%. Warren Buffett replied that he had not lost anything in 2009. Becky Quick said, "Well, how is that, Warren?" And he said, "Well, I haven't sold anything." So there you go. If you sell into a down market, you're just locking in your losses. She also asked him how long his holding period is on stocks, and he replied that his holding period is forever. So stocks are a part of our life. Stocks are a part of something that we likely will need to beat inflation and grow our money over our lifetimes. Now, if you're invested in equities, one of the best ways to protect yourself from market downturns is to be prepared before the market goes down so you don't have to repair after the market goes down. That was a quote actually by John Maxwell. How you do this is to make sure that you have buckets of money. And what I mean by buckets of money is make sure that you have 3, 5, or 7 years of what you're going to need for income and expenditures in more safe, reliable investments such as cash, bonds, annuities, real estate investment trusts, things that have a lot more stability so you can use that for your income needs if the stock market is down. So most of our clients have income buckets that are built up and they're able to ride out this current market volatility. Well, I think we know why there's been a shortage on toilet paper. Of course, the stock market being down what it is, it's scaring the you-know-what out of people. So here's somebody's house. I can see they've bought a lot of rolls of toilet paper. So the toilet paper manufacturers like Kimberly-Clark are probably doing pretty well with their sales. And looks like Home Depot is doing pretty well with their sale of toilet paper holders. You might remember back in the 1970s and 80s, there was a cartoon on called Scooby-Doo. And Scooby-Doo and his young adult friends would actually go out and solve mysteries in their mystery van. And at the end of each show, they would have Fred would go up to whoever the criminal was, and he would say, "Let's see who's really behind the coronavirus." And he pulls off the mask. Let's see who's behind the mask. It turns out it's the Charmin Bear, an American manufacturer of toilet paper. Charmin Bear, he just wanted to sell more TP. Ha ha. Anyway, back to a little bit more serious note. The economy was in very good condition before all of this trouble started. We had very low unemployment rate. Corporate earnings were coming in quite strong. Good government policy, low interest rates. We had the tariff talks were going well and with China and other countries. And then all of a sudden, whammo, we entered into the fastest bear market ever. So within a 19-day period, the market went from all-time highs to 30 to 35% downturn. This oftentimes is what we call a black swan event. And a black swan event is defined or has 3 characteristics. Number 1, they are unpredictable. And I would say that this coronavirus was definitely unpredictable. Number 2, they have a big impact. And number 3, afterward, people think the event was predictable. So oftentimes investors go, "Oh, yeah, I guess I saw that coming. I knew it was coming, but I didn't do anything about it." Well, let me tell you folks, a lot of people saw it coming, could feel it coming, but never did anything about it because nobody realized what the gravity of this coronavirus would be on different economies such as Italy, Europe, China, Korea, and the United States. So very unpredictable event that we've just had here. Now, if you look back as to why it was so unpredictable, if you look at previous outbreaks and how they impacted the stock market, this is a timeline of major global health events since 2002. You might remember the SARS virus that was in March of 2003. And I vaguely remember it, but I was out for a walk with my lovely wife the other day. And of course, I'm sure everybody else is out doing their walks because you can't go to the gym or the golf courses or the tennis courts or anything like that. And she was reminding me, she said back in 2003, she was donating to our local school tubes of Purell hand cleaner, hand sanitizer. So back in '03, the classrooms were just getting into, okay, well, let's make sure everything is sanitized quite well. So I think Purell really took off in 2003. Of course, we had the swine flu. That was April of 2009. And during the swine flu outbreak, which, if we look at the 1-year stats on that, there's actually 60.8 million cases of swine flu here in the United States. 274,000 people were hospitalized and 12,500 deaths. So the swine flu outbreak, during that period of time, the stock market actually was going up. 6 months after the stock market, the swine flu outbreak, the market was up 30%. But of course, the market was rebounding off of some all-time lows created by the housing debacle. Then, of course, we have Ebola. Ebola is completely different. That's a 90% death rate if you get Ebola. And then, of course, the Zika virus you might recall from a few years ago. So the coronavirus, we don't have any final numbers as far as what the 1, 3, and 6 months damage it'll do to the stock market. But again, based on previous outbreaks, nobody would have said, oh, well, let's get our money out of the market because viruses will make the market go down so much. There's been a lot of different crises over the last 100 years. People on this phone call probably remember the housing debacle, Y2K, probably remember the terrorist attacks, recession after that. You might recall back in 1987, the Black Monday. My first downturn in the market that I experienced was actually in 1990. And the stock market went down and my phone rang at the office and it was my mother calling. And I was like, uh-oh, I'm in trouble here because I didn't recommend that my parents take their money out of stocks before the market went down. And my mother said, Sean, I've been watching Dayton Hudson stock and I see it's down in value. Will you buy me another 50 shares? I said, sure. Yeah, that makes a lot of sense. Buy low. Later on in the day, my father called me up and he said, hey, Sean, I was looking at Best Buy Company stock and I see it's at a low point. Buy me another 100 shares of it, which I did. So that's, sometimes what investors should be doing, which is oftentimes difficult to do. But we do have a few different investors that have been investing into the market as it has been going down. Now, one of the things that investors think they can do is market timing. And market timing is pretty much impossible to do, as you'll see from this chart right here. This is actually the rate of return of stocks from 1990 through 2019. If you just left your money fully invested, your average growth would have been 7.7% per year. Now, if you missed the best day of return in each year, your actual rate of return would have been 3.9%. So you've just cut your rate of return in about half. If you miss the 3 best trading days of each year, your rate of return would be a minus 1.8%. So there's 254 trading days where the stock and bond and commodity markets are open. If you missed 3 of those days where the market's going up, your rate of return, again, would have been a negative 1.8%. So market timing is a very difficult thing to do, and we highly recommend not doing it. But again, being prepared to ride things out over the long haul. A good example of market timing is if you would have taken your money out of investments or stocks earlier this week on a Monday, you would have missed out on a 4 to maybe even 5,000 point gain in the stock market all within 1 week. So when should you invest if you're not invested right now? Well, what we're seeing in this chart, it's looks complicated, but it's quite simple. Basically, as the cases of coronavirus begin to fall on a global basis, as well as here in the United States, that's when we will see, or that's historically what we're seeing with the stock market, is virus rates go down, stock market goes up. And so from what I'm understanding with the the restrictions that have been placed on many different states, that to shelter in place, as well as non-essential businesses closing down, I think that it'll flatten that U curve pretty quickly, and we'll see a lot less cases, diagnosed cases around the different states. So that's what we all hope for. Now, once the crisis is over, this slide here goes back to 1907, and it illustrates, there's a crisis, but then after the crisis, for the, excuse me, over the next year, they're showing here over the next 253 days, the average return of stocks is almost 15%. So again, when the market does turn, historically, the returns are pretty robust. Now, a couple last slides here. This illustrates going all the way back to 1926. Investors oftentimes they'll say, okay, well, I'd like to have a 5 to 10% return on my stocks each year. And it's very rare that you actually get a 5 to 10% return on stocks. So as you see here in the year 2007, 2005, 1992, 78, 56, 48, and 47, equities or stocks returned 5 to 10% growth. All these other blocks and all these other time periods, the stock market was actually above 10% all the way up to 50%. And then from this line right here, stocks were positive, but about a third of the time, stocks actually post a negative rate of return. So on average, what we're seeing here, about 70% of the time, stocks are up. About 30% of the years, stocks are actually down. So that, as investors, I think you need to know what you're getting into, that it's not always a perfectly straight ride with a 5 to 10% return. Oftentimes it's a very robust return, or maybe a flat year or a down year. But again, that's why if you're invested for the long term, you can ride out these bumps in the market. This is some news from today. Senate passes $2 trillion bill to blunt coronavirus pandemic's economic impact as households and businesses gasp for relief. And so this is good news for our economy because it will help businesses with that have no customers and no sales going on right now. It'll also help the people that are unemployed or facing unemployment, where from what I've heard so far, the people that are unemployed will have up to 4 months of pay at, I think it's going to be 100% of what their salary was. So we'll wait and dig more into the bill later this week. That's a little bit of the reason why the stock market has rebounded sharply this week. Here's some action items that you might want to consider. Number one would be make contributions to your Roth IRA accounts and other investments right now, earlier in the year. So basically, we're advocating that you possibly could be buying low into the market, especially for longer term investors. Evaluate converting your IRA to a Roth IRA. So basically, if you're doing a Roth conversion right now, you're converting a lot of shares at lower share prices and lower tax rates. So then when the market does rebound, which historically it always has, you'll have accomplished a lot more in Roth conversion. Third thing, realize capital losses for tax loss harvesting. And so that might give you a future tax benefit to offset capital gains down the road or offset ordinary income. Fourth, discuss risk level and current allocation. So if you're feeling good about your portfolio, maybe you say, okay, well, I could maybe take a little bit more risk. Or if you're not feeling good or having sleepless nights, then you might say, okay, well, I think I want to take some risk off the table and just protect myself. Number 5 would review alternative investment products such as annuities and REITs. So annuity products, again, those are designed to give you guarantee income streams designed to protect your principal. And because many investors don't have pensions these days, annuity products are very suitable to replace fixed income as well as give you guarantees. And then REITs, what that is, would be real estate investment trust, which is considered to be a non-correlated asset that's not in the stock market or bond market. Number 6, schedule a phone review with your advisor. And of course, feel free to call my office at any time. Our local number is 651-490-2939, 490-2939. And then our toll-free number is 866-314-1993. Very easy to find in my email body if you're looking for an appointment or if you want to discuss your portfolio. And then number 7, pay attention to government benefits. There might be some things that you'll be doing if you're still employed, and there's some different family credits and cash that will be coming from the government. And of course, number 8, stay safe and protect yourself from the coronavirus. It's obviously from what you're seeing on TV, it can be very deadly, especially to those people that have compromised immune systems or lungs, or might be, over age 60. So take care of yourselves, and we'll try to keep you posted. LPL's research department, I think, has been doing a really good job. They have 42 research analysts. That actually is the largest research department off of Wall Street. And so hopefully you're getting our emails and the different blog posts that they're putting out. With that said, I thank you for your time today. And once again, feel free to call my office if you have any questions. Thank you.